There is one indicator that completely transforms our ability to pick winning stocks. Most people search for the best companies based on past performance, but there is one crucial problem. If I'm screening for the fastest growing companies based on their revenue or profit growth, then I am more likely to end up with the opposite, a company that is likely to slow down in terms of profit growth. In this video, I'm going over what the peer-reviewed research says about past performance, why it doesn't work for most people, but there is one metric that we can add to completely transform our results. So let's start with the peer-reviewed research on past performance. It is well documented that earnings growth on average is mean reverting. What does that mean? So mean is the average. So companies on average tend to end up at the same average growth rate. And this expectation can be used to achieve better results than the professional analyst. This article right here from the Journal of Finance says expectations about long-term earnings growth are crucial to valuation models and cost capital estimates. We analyze historical long-term growth rates across a broad section of stocks using several indicators of operating performance. We test for persistence and predictability in growth. While some firms have grown at high rates historically, they are relatively rare. There is no persistence in long-term earnings growth beyond chance. And there is low predictability, even with a wide variety of variables. So let's break that down. What do they mean when they say there is no way to predict long-term earnings growth beyond chance? Well, they have a table that illustrates this point. The x-axis shows the number of years in a row that a company is able to achieve above median growth rates in profits. So right here, average number of valid firms out of 2,782, 1,391 were able to achieve profit growth above the median for 1 year. Then that number shrinks to 625 for 2 years, and then 277 for 3 years, and so on, all the way till we get 10 years in a row of above median profit growth, only 2 firms left. And if we look at the proportions of firms, they perfectly match what you would see for random chance. Basically, flipping a coin would give you the exact same results. We can see that this top row right here is the actual number of companies that achieve above median growth. And then this bottom line right here is the expected number based on pure chance. So we would expect 50, 25, 12.5, 6.3, 3.1, and it virtually matches exactly that, going all the way to 10 years. So if we're screening all the companies in the stock market and we're just looking at the ones that are growing their earnings faster than normal, it's more likely in the future that they're going to dip back down and return back to the median or return to the mean. This is what we mean by mean reverting earnings growth. And this is documented by many studies. And in fact, by assuming a mean reversion in earnings, you can outperform analysts at this time. Now, there has been additional research that has come out that sheds a little bit more light on how we can get an advantage over just the average company reverting to the mean. And that's if we take into account the life cycle of the company. Now, you can find many different ways to define the company life cycle, but for the purposes of this study, we're using this definition right here. Companies always start with an introduction phase, followed by growth, and then into maturity. Then there is a shakeout period where they are starting to decline in their growth and they're trying to either pivot into a new growth phase or they go into decline. And then eventually you have the death of a company. Now, it's important to understand that these are not always perfectly linear. Companies can move back and forth between this range of cycles. So companies can experience growth, they can mature, then they can have another period of growth without necessarily going into the shakeout period. Some companies decline immediately after topping off in their maturity phase. So there's a little bit of nuance here, but when you control for companies in different life cycles, we get some really interesting results that go against the mean reversion of profits when you are just screening for all companies evenly. This study, which looks at using cash flow patterns as a proxy for the firm life cycle, found that return on net operating assets, this is their metric for profitability, does not mean revert when sorted by life cycle stage, which has implications for forecasting growth rates and for determining forecast horizons. So what exactly does that mean? Furthermore, market participants undervalue mature firms, specifically those with extreme book to market ratios. So what they're saying is that companies who fit into the mature section of the company life cycle are undervalued because the market is assuming a mean reversion of profits. But when a company goes from a growth phase to a mature phase, those additional profits stick and they do not revert to their previous mean. Now, this doesn't mean that all mean reversion goes away. It just means that if you assume mean reversion based on the company's life cycle, then your accuracy in predicting future earnings increases. So here is a more recent study where they looked at different life cycle mean reverting metrics. So mean reversion in profitability and growth is a well-documented phenomenon. However, we know comparatively less about the underlying process that drives the mean reversion. In this study, we extend this literature by investing the relative forecast accuracy of mean reverting models based on the firm life cycle. In the past, they achieved slightly better results by modeling using economy-wide parameters or industry-wide parameters, but now they get the best results using cycle of life parameters. Consistent with this expectation, we find that life cycle models improve forecast accuracy of both growth and profitability forecasts, outperforming economy-wide and industry-specific models in forecasting a wide range of profitability and growth measures in the short term and the long term. And when I scroll down to their results section, I can see the magnitude of the differences. So in this first table, they lay out the mean or the average growth and profitability if they're just looking at all companies. So they use 3 metrics to show growth. They have growth in sales, growth in net operating assets, and growth in common equity. This is like the book value of a company. And here are the averages for growth: 0.07, which is 7.7% growth per year. We've got 6.66 growth per year and 6% growth per year. As far as profitability, they use return on net operating assets and they use return on equity. The average for these two are 12.8% and 5.9%. In panel B, it breaks down all 5 of these metrics by the 5 different stages. So if we're looking at growth in sales, this is revenue. This is one of my favorite growth metrics to look at. We can see that the average previously was 0.7, but the averages by intro and growth are much higher at 11%, while the growth of a mature company is actually lower at 5.29%, which intuitively we would expect. And then when we go over to return on net operating assets and return on equity, we can see that the averages are much higher for the mature section than they are anywhere else. And then finally, if I look at the standard deviations for all of these different metrics at all the different life cycles, we can see that the standard deviations for the mature life cycle are the lowest. The standard deviation is a measure for how much variance there is in the data. So if we have a bigger standard deviation, it means that there's a wider range of data. So I like to see that mature actually has the lowest standard deviation, meaning it is going to fall within the most narrow range on average. But looking back to profitability, if we're comparing mature and growth, we can see that return on net operating assets on average increases from 12.5% to 16.5%. That's almost a 33% increase. And then on return on equity, we can see that the growth on average increases from 5.7% to 9.38%. Now, that is a 65% increase. So we have significant increases in profitability going from a growth company to a mature company. So what I might look for is a company that is recently transitioning from a growth stage to a mature stage where the market might not give them credit for sticky profit increases. They might be assuming that this company is going to return back to their average profitability, but they are transitioning to a mature phase where their profitability is a little bit more sticky. And this study also backs up that conclusion. When conducting valuation analysis, practitioners and researchers typically predict growth and profitability separately, implicitly assuming that these two value drivers are uncorrelated. However, profitability shocks increase both growth and subsequent profitability. So what are they saying? They're saying when a company has unexpected profitability, a profitability shock, it increases both their future growth or their current growth and their following profitability even more, which would be consistent with a company that is suddenly more profitable. They're going from their growth phase to their mature phase. They are enjoying the economy of scale. They're increasing their efficiency. And so therefore, those profit margins are more likely to stick. Okay, so all that sounds great, but how do I actually implement this metric on a stock screener? I mean, there's not a section that says, oh, I want to only look for mature companies, right? One of the studies that we looked at investigated using cash flow patterns as a proxy for Lifecycle, and they were successful. So we can see that in the introduction phase, you can expect negative operating cash flows because the firms are entering the market with a knowledge deficit about potential revenues and costs. They have negative investing cash flow. So they have a lot of optimism that's driving them to invest a lot into their company. So when we have a negative cash flow, it means cash is leaving the company in this section, not coming into the company. So if you are spending money on investing, then you would have negative cash flow on investing. And then their only source of positive cash flow is from financing, which would make sense because they don't have the profits yet to finance their growth. Then as they move to a growth phase, they actually start to have positive cash flows from their operations. Their profit margins are being maximized. However, they are still investing heavily. So they have negative cash flow in terms of investing, and then they still require financing typically at this stage. So they're still bringing in more money from issuing debt or issuing more shares. And then when a company moves to the mature phase, they are maximizing their efficiency, which increases their profit margins. They still typically are investing, but the big change here is their financing flips. They are now focused on paying down their debt, which lowers their interest payments, which increases their profit margins even more. So this is the big flip. We're looking for positive operating cash flow, negative investing cash flow, and then negative financing cash flow. On stockanalysis.com, I can set up my screener to account for these cash flow profiles. So I simply go to the stock screener section and add filters. And I'm going to scroll down to the section on cash flow. Right here, cash flow section, I can have operating cash flow, investing cash flow, and financing cash flow be a part of my screener. So as I X this out, I can see right now there are 5,498 companies. Let's see what percentage of them are mature category companies. So for operating cash flow, I just want a value over 0. For investing cash flow, I want a value under 0. And for financing cash flow, I want a value under 0. This leaves me with 1,861 stocks that fit this criteria. Now, I'm not going to just stop here. I also want to see companies that are growing their revenue significantly because I'm most interested in companies that are having a profitability shock from increased revenue growth and increased profit growth. So how do I do that? I want to add a filter for revenue growth. If I scroll down to the revenue and sales section, I can add the revenue growth over the previous 5 years. So I want to see a high average. Now, if I remember what the average revenue growth was for a growth company, it was about 11%. So I'm going to look for companies that have revenue growth on average over the last 5 years of over 10%. This gives me companies that are in the mature phase in terms of their cash flow, but they have the upper end of revenue growth for companies in the mature section. So it makes it a little more likely that they have just recently switched. So now we're down to 632 companies. And one more thing I could do to find companies that are more likely to have just moved to a mature phase is I can find companies that have recently increased their profitability. So the way I can do that on this screener is I can look for companies that have a lower average profitability than they do a recent profitability. So if I go to add filters, let's scroll down to the return on assets and return on equity. In the financial performance section, they give me 3 different options for a past 5-year average. I have the return on assets over the last 5 years, return on equity, and return on capital. Now, in the study, they used return on net assets, which is a little bit different than return on assets. They also use return on equity. I personally like to use return on capital employed because I find it's more likely to be useful for a wide range of industries and a wide range of sectors. Now, it is important to take into account differences within an industry. So return on capital in one industry is going to be projected to be different than another industry. So an additional filter you could use is you might look at companies by industry and compare that way. But for the purposes of this, I just want to see an increased return on capital. So I'm going to look at the average over the last 5 years, and I'm going to look at over the last 1 year. And I want to see companies that have a return on capital higher in the last 1 year than their average over the last 5. Now, unfortunately, there's not a way to, on stockanalysis.com, to filter these for just the companies that are higher in return on capital. Like I can't put a filter in to compare these two. I just have to visually do it. And then the only thing that remains is I still have to take into account valuation. So just because there's a mature company that has grown their revenue a lot recently, and they've recently become more profitable, that's not enough for me to conclude that this company is a good investment because their valuation might be too high. They might be too expensive in terms of their expected earnings and their current earnings. So it's also important to have a filter for valuation. I like to use the free cash flow. So that's my favorite screener to use in terms of valuation. So I like to use the price to free cash flow ratio. I'll also add that. And I like to see it to be under 20. However, I do like to use the between, because if you don't say between 20 and between 1, then it will include companies that have a free cash flow of undefined, which it reads it as a 0. And these are companies that have negative price to free cash flow. So after making that adjustment, I see only 295 stocks remaining. And then if I want to do one more adjustment here, I want to see a high return on capital. If I go back to my study, I can see that the return on net operating assets average for a mature company is 16.5. The average for return on equity is about 9.5. So if I go back to my screener, let's filter for companies that have a return on capital recently that is over 10%. So I want to see high return on capital. I want to see that return on invested capital to be greater than the previous 5 years. Also, one more filter I like to add is market cap. I generally like to invest in larger companies. I find them to be a little bit more consistent and a little bit safer. So I put in over 10 billion on market cap. And so now let's filter by market cap here. Let's see what we got. UNH, Adobe, Qualcomm. So if I'm also looking at return on invested capital and I want to see it higher than the average, I can see that Adobe fits this criteria. They have 26% return on invested capital in the last year. Their average for the previous 5 years was 20%. Their revenue growth over the last 5 years is 13.41, which is above the average for a growth company in terms of their life cycle. And of course, they have high operating cash flow and relatively low but negative investing cash flow and very negative financing cash flow. So this tells me that they're paying off their debts, they're maybe buying back shares of stock, they're maybe paying dividends, and they are still investing in their growth. That would be an example of a company that seems to fit the criteria. Now, that doesn't mean that I'm going to turn around and just invest in Adobe. Spoiler alert, I have invested in Adobe, but there is one more step that is vitally important. You have to do a deep valuation dive on the company. You have to know, is this company overvalued in terms of their future projected earnings or their future projected cash flows? If you want to see how I do that calculation, check out this video right here. Hope to see you there.